Hi, and welcome to this episode of the AIIA's Indo-Pacific Briefing, where it's our mission to help Australians know, understand and engage more in international affairs. Our guest is Professor Peter Draper, Executive Director of Adelaide University's Institute for International Trade. Peter is a seasoned international trade expert and practitioner, having advised governments and multilateral institutions, including the World Trade Organization, the African Union, and the BRICS in the G20 context. In this episode, Ian Lang is talking with Peter about the complexities of the international trade and economic system, how it's entwined with peace and conflict, and the pressure points that threaten its foundation.
A global financial crisis, or a new global financial crisis, is not an inevitability, I would say, but it's becoming increasingly in the cards, I think. The erosion of institutions, particularly, the declining confidence of markets, and particularly the bond markets, in the government's capacities to manage the national debt particularly. And so, for instance, there's early warning signals. The New Zealand Sovereign Wealth Fund, which has been the best managed and best performing sovereign wealth fund for the last 20 years, announced recently that it's going to start decreasing its level of exposure to US Treasury bills particularly, which is how that national debt is funded. So one of the important offshore investors is relatively small, but it's an important signal to the markets that investors are getting nervous and looking for alternatives. But I think financial markets are strange beasts. There's a herd mentality at work. Right now it's just a trickle. We don't know at what point it might become a flood, but if and when it does, then everyone will know about it. It's not the only potential for global financial crisis out there. There is the Chinese story, obviously, much more opaque, but there are big debts, much bigger debts actually, that have built up in the Chinese financial system that we should be paying attention to as well. Both defaulted simultaneously, let's say. I think it would make the GFC, the 2008 global financial crisis, look like a relative picnic, so to speak, given the relative scale of the two economies and the extent to which the rest of the world depends on them, particularly the United States financial markets, but China is huge in this context as well. It's a much more closed economy, of course, than the United States. But the Great Depression of the 1930s essentially saw all the major developed countries go into a synchronized financial crisis. And I think you would see something like that on a much bigger scale rolling out across the world, so to be feared and avoided at all costs. I think the reality is that Australia is a very small player in all of this, so what we do really matters at the margin. It's the decisions that are taken in the United States and China that will be determinative, and that's just a reality. Currently, the US dollar accounts for roughly 90% of global currency transactions, 90. That's an enormous proportion. So the US dollar is still the currency of choice. The yuan's usage in global currency transactions is much lower even than sterling and the yen, or even the Swiss franc. But it's growing, and it's growing rapidly, and the potential is there. The issue is that for China, its capital account is closed, and that makes China unattractive as a potential reserve currency option currently. It's also the market's confidence in US domestic institutions, and this is why I come back to the ways in which the Trump administration is managing those institutions is highly worrying, I would say. His targeting of the Federal Reserve and the independence of the Federal Reserve is deeply troubling, and financial markets should be much more concerned, I think. Some major Australian commodity trades in particular, for instance of barley, they were able to diversify pretty quickly because global markets for that particular commodity are pretty liquid, so to speak. Similarly for coal. So instead of going to China, it went to India. But there were some export products, thinking wine in South Australia, for instance, that couldn't find new markets quickly, or South Australian lobsters as well. And so those industries really suffered. Wine is recovering now. Lobster and the lobster trade remains relatively depressed. So there have been certain pockets of the Australian and South Australian economy, long-lasting impacts. So diversification as a trade policy choice makes sense on paper. To do it in practice is very challenging. China, in its successful industrialization drive, borrowed selectively from the West. The parts that are borrowed from the West were forming and opening up, particularly the coastal zones, which became laboratories for broader experiments with liberalization. They were highly successful, obviously. But the interior of China and all the old state-owned enterprises, that's the second part of the model. Putting it together, and now they call it a dual circulation model. So you've got the state-sponsored system largely domestically, largely sealing itself off from the rest of the world. Value chains are managed domestically, everything supplied internally, that's the intention. But you've still got the coastal export zones, and the challenge for them is, as Mr. Trump's reciprocal tariffs start to bite, and the Chinese economy starts to slow down, those exports need to go somewhere, and domestic prices in China are decreasing. There's a fierce price war going on that will intensify, so deflation is starting to take place in China, not just disinflation. I can distinguish between those terms if useful, but deflation, so decreasing price level like Japan experienced for 2 decades. Very difficult to extricate yourself from. But those exports, they get exported at cheaper prices, and very often subsidized prices, which is part of the Chinese industrial capitalism model. So that creates a range of problems for trading partners. The United States is investing in critical minerals because it's worried about domestic supply security, access to those critical minerals. So it's subsidizing the production of those critical minerals, as Australia is doing here on a much smaller scale, obviously. And the reason we're both doing that, and we're not the only ones doing that, is because 90% on average of critical minerals are processed in China, and then China exports those to the world. Now, those critical minerals products are used in a range of applications, but particularly defense industries and green transition industries. And China effectively has a chokehold on the exports of those processed critical minerals, so to speak. So the US government is going to throw a lot of money at this. Australia is going to do the same. But we also want to export. And they'd be quite happy to import it from Australia because we're not China. And in that sense, it's also a big opportunity for us. The broader challenge, though, is we're dealing with the Trump administration, and they want everything to be produced in the United States. The Chinese aversion to alliances is more of a geopolitical framing. The Cold War mentality, as the Chinese leadership call it, and it has more of a military application than an industrial application. But for the Chinese, they have the scale to go it alone. Australia, we don't have the scale. We need the investment dollars coming in. If it's not a sensitive area for investment, we're quite happy to take Chinese investment dollars too, by the way. So this gets really interesting. So which parts of the economy are sensitive and which are not? This is the basic economic security question. Much depends on who's asking the question. So who would our major competitors be in the Indo-Pacific? These would primarily be, given the nature of our trade structure, commodities producers. And many of those are Southeast Asian countries. So Indonesia actually is a competitor in nickel production, where Indonesia put a particular policy and framework in place, highly successfully, so export restrictions, that forced, in essence, Chinese and Korean battery producers to invest in Indonesia to source their nickel and process it there. So much supply eventuated that the nickel price collapsed and Western Australian nickel producers went out of business. So Indonesia, the potential is huge, so 300 million plus consumers. That Indonesian middle class is growing all the time. And so for Australian exporters thinking diversification, as well as Australian investors, that's a very important market to keep an eye on. But broader Southeast Asian markets, thinking Vietnam, Malaysia, you've got Thailand, so right on our doorstep, big, important, emerging market propositions. So migration is an important driver of Australia's economic growth. Certainly when the Treasury puts together its budget models and forecasts, migration and migration statistics are an important driver of the growth numbers. If migration comes off, the growth numbers go down. It's also the availability of the labour pool. So we have, by global standards, and certainly developing country standards, high rates of employment, which means low rates of unemployment, and relatively high labour force participation. If that migration number starts to come down, particularly skilled migration, bottlenecks will emerge pretty fast, labour costs will go up, inflation will go up, not good for the economy. The broader debates about climate change and all its impacts, we should distinguish between the adaptation impact, so how do we respond as a nation to climate change in all its manifestations, floods, droughts, etc., fires and so forth, natural disasters, and how we mitigate the incidence of greenhouse gas emissions. And we shouldn't confuse the two. The Australian government is about to release a major report on the full set of impact of climate change on Australia's adaptation requirements, I suppose. For example, the algal bloom in South Australia, which has impacted on tourism numbers directly. Foreign investment is essential for growth. That's clear. For employment, they bring new technologies in typically. Those diffuse into the economy. Important for a whole range of reasons. China is a relatively small investor in Australia if you look at the stock of investment. And it's concentrated largely in two areas, mining particularly, and land, and associated with that some farming acquisitions. So why should we worry about China owning ports in Australia or strategic infrastructure? It's because we're worried about China's military intentions, and behind that its military capacities. A major factor behind that is the nature of the Chinese system. I think we don't want to be ruled by the CCP, let's just put it simply. So if the CCP, through one of its state-owned enterprises, acquires a strategic port in Australia that is used by the Navy, I would say don't allow that investment. If you think about the total quantum of iron ore available in Australia, it vastly exceeds our domestic needs. There could be, for instance, I suspect, niche green steel export industry that emerges as well, and particularly in the Pilbara, Western Australia. But at the end of the day, we'll be competing with the major producers, the major current producers. Japan, they converting to green steel. Koreans, same story. The Chinese, some way behind. So can the green steel proposition reframe Australia's iron ore sector? And I think the answer to that is yes, but it will take time. And I suspect most of the value proposition for Australia lies in converting iron ore, in particular grades of iron ore, into green iron ore. Trade promotes peace, which I personally, at a broad level, subscribe to. However, when you review the literature, you will see that the evidence is rather mixed. Counterexample, where that hasn't proved to be the case. In the build-up to World War I, there was this thinking in evidence. The Europeans were getting richer together. They'd gone through this period of UK or Great Britain sponsored trade liberalisation agreements and trade integration, but they still went to war. This is why the post-World War II liberal international economic order was created by the United States particularly and the United Kingdom. Unfortunately, this is the system that Mr. Trump is now in the process of not just unpick it, really take a sledgehammer to it. And that's very worrying. So how the rest of us respond to this is a key issue. And unfortunately, at a global level, we are not responding well. We are conniving, in essence, in Mr. Trump's hubris.
That concludes this episode of Indo-Pacific Briefing with Professor Peter Draper. It can be argued that the current international economic system has served nations well since its establishment after the Second World War. However, this order is now on shifting sands, with its foundations buffeted by the battle of ideas and systems between the United States and China, as well as the multitude of economic, social and environmental risks. How Australia positions itself with its partners and within the international economic system, and how policymakers handle these risks will no doubt determine our future economic and social prosperity. This has been Indo-Pacific Briefing. Looking forward to seeing you at our next conversation.